Hey, what's up, everyone? Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
Oh, today, guys, we have home price pressure. I don't know if we're entering a buyer's market or not, but we're going to talk about that a little bit today. There's some evidence, I'll say documentation, that is suggesting that we might be at a neutral place, but I'm not so sure about that. I don't know what you guys think. We're going to talk about that. So there's a couple of things in succession, and the first one actually comes right on the heels of new data from the June home sales report. So from CNBC, we have June home sales slump, pointing to a buyer's market as supply increases. So supply increase is something we've talked about a lot, but the sale of previously owned homes dropped. So you have that dropping June of 23 to June of 24 by 5.4%.
I know, I saw that. That's crazy.
I'm sorry, I misstated that. It's in May. So the sales of previously owned homes dropped 5.4% in June compared with May, and then inventory jumped 23.4% from a year ago, but I mean, we know that was in the gutter. So median prices going up. There's home prices on the table. There's the rate of speed for previously owned homes selling. What do you guys make of this?
Well,
What's going on?
the rates are still higher than last year, right? So that has a lot to do with this, as we're starting to see more inventory because of that. So a lot of buyers are still on the fence. They're not going in there. So we're starting to see a tick up in these in this market. So I totally understand that. The good thing about it is homes have more supply, which is good. Last check, we had over 689,000 homes available. And of course, this is nationwide.
Currently listed, right?
Yeah, currently listed. Whereas, in January, we started like between 400 to 480,000 to 490,000. So that is a good uptick. And that's why we're starting to see homes staying a little longer and, on the market.
So here's the interesting thing, though, and this is why I wanted to know. It's notable because, one of the claims is that we might be turning to this buyer's market or maybe at least a neutral market, but prices are staying the same. So there's a ton more supply, so prices stay the same. What do you make of that?
Yeah, I mean, it's because, once again, we have more supply.
I feel that once as more inventory starts to present itself, I think the market will start to, stabilize the prices, but up until we get a lot more inventory, I think prices will stay, at the levels that they are. And including as we start to see mortgage rates kind of dwindle down into the later parts of the year, that's also going to have a lot of influx of more buyers. So I'm very curious to see what the market does and those people that do, unlock that golden handcuffs off their mortgage to see if they're actually going to, list or play the field to see, what the market does in the later, months of this year.
Yeah.
He just said play the field. So the reason I'm asking the question, though, is because typically, like the theory is, well, when there's a lot more inventory of something, prices will ease up, but we're not seeing that. So why is it that we have this kind of this? Normally, it's like a push-pull kind of effect, but it's not happening. But what do you make?
We got to remember that it's a nationwide thing that home prices. home inventory is going. So every area is going to be unique to it. Yeah. In San Diego, we're still seeing home averages staying on the market. If they're priced right, anywhere from 22 days to 30 days. Yeah. And if they're overpriced, and we're starting to see a lot of price reductions. And I'm going to go back to the whole thing, like I, as a homeowner, think my house is worth $1 million, right? Yeah. So I want $1 million, and I want my realtor to put it for $1 million. But the market, the buyers are going to indicate what that proper value should be, because that's where you'll see the activity of, people's interest wanting to put an offer on that home. Mm-hmm.
So so let's localize this a little bit, because, for here in San Diego, are we seeing more or less inventory, would you say?
A little more.
A little more.
A little more.
But that's not negatively impacting home prices to the downside.
No.
If anything, we're still seeing multiple bids, but maybe just less multiple bids. So it's not like there's 50 people offering on the house, there's 4 or 5.
Yeah, correct.
Right? And that's an exaggeration, but you get my point.
One of the 2 examples that came up these last couple of weeks was that both the houses that one of our clients who were going to get into both came up with some work to be done in them. And in the most cases, what they ended up happening was that they reduced the price and put it back on the market. And that's something that I'm starting to notice. And even in her house that she's currently selling, same thing, the buyers backed out because there was certain stuff that was wrong with their property that the buyer asked for credits, but then it goes back to the homeowner. Hey, no, my house is this is what I want, and I'm not
$1 million with no repairs.
But keep in mind that their house does need some repairs. They're going through a divorce, so one party's like, yo, I need to sell and get out of here because I'm actually actively looking, and the other one's still sentimentally, attached to the property, wants a certain number. And now that they're seeing that more, that all the offers that they could have gotten, they didn't accept them. Now it's kind of like a ghost town. So what does that mean? That they're going to have to drop their price down, and then now they lost an opportunity of being able to get any offer higher than what they wanted it because of the fact that their emotions was set on one price, on one profit, and if it didn't match that, they weren't budging. And unfortunately, one of the parties is suffering because they can't sell unless both of the parties are
So I mean, going back to that, pending home sales have dropped. Price reductions are higher this time around than last year this time around. So we're starting to see that. We're also getting news that interest rates are going to go down.
Right.
So actually, for me, I think people kind of are kind of not pulling the trigger so fast because they were saying like, well,
how low can they go? Let's see how low they go towards the end of the year.
I think that's 100% in play, and I also think that it's partly because. First of all, it hasn't really happened yet. We've seen some easing on the mortgage side before the Fed, the proposed Fed cut's going to hit us in the fall. But I think it's a combination of things. Like there's still appetite that's matched with willingness to pay and the ability to pay at this price still. So even if more inventory comes up, it's soaking up additional demand that's still pent up.
Yeah,
I think that's part of it. I don't know that it's 100% of it, but I have to just wonder, why is this push pull effect not in play in this case? And I think it's because of demand.
No, absolutely. Andy, I agree with you. And you're talking about earlier about the homes still increasing. Well, it's crazy here on this article. It says sales of homes priced over $1 million was the only price category seeing gains over the last year. I was like, what?
Yeah, isn't that crazy?
And then it goes to say that while the biggest drop in sales was the 250,000 and lower range. I was like, wait, come on. I had to read it twice. I had to take a double read.
Where are those?
Right? I mean, obviously they're talking about a nationwide type of deal, you know, but that's just pretty crazy. So you're telling me like the $1 million homes have more gains? But a home that's way more affordable in the 250.
Here's what's crazy about that mathematically, because it goes right next to that. After that, it says the median listing price is being held down. So the median price has been pushed up to $426,900, which is an increase of 4.1%.
Yeah.
So it's higher this year than it was last year. Higher nationwide this year than last year. Don't get that mixed up.
Yeah.
And they're still saying that is being held down by an influx of smaller and lower price listings. So even though the $1 million plus houses coming up, volume wise, there's not so many that it can't keep the median price being held down by the bottom tier. That is nuts.
Right.
That tells you how much is happening there and how much it's, like, I'll say outweighed, even though its price is high. It's being outweighed or held down by these $250,000 or below homes. That's nuts.
Yeah. And I mean, the other thing we've been seeing is also the investors that came down at the bottom also. It says higher end buyers tend to use more cash, and 28% of their sales were all cash.
All cash.
That's pretty nuts.
That's a lot. And up from last year by a substantial amount, like 26%.
Yeah. Yeah.
So it's like they've done less, but the ones they're doing with more cash.
They're doing more cash.
Which is crazy.
Exactly.
So this kind of dovetails into the next thing. So you guys cool if we kind of go to the next one?
Yeah.
Okay, cool.
Yeah.
So
this is pretty cool.
So we have here that some renters may be mortgage ready and not know it. And here's how to tell. So this is also from CNBC. These were kind of published in the same little window, which is why I put them kind of back to back for us today. Among those who did not own their home, roughly 7.9 million families were considered income mortgage ready, Zillow found in a study. Now, that's a lot of people. That's nearly 8 million people. You could cut that in half and tell me, Andy, it's 4 million, and I'm still going, wow. Well, now we have an even bigger inventory problem, and we have a demand issue that's going to keep prices higher. So I was surprised that it was this many people, honestly.
Of course.
Given the nature of what we deal with when it comes to debt to income ratios and that kind of thing, I was honestly surprised it was that many people. How can we get some of those people from off the fence from paying rent that is the equivalent of a mortgage into a mortgage?
Yeah. I mean, it makes perfect sense. A lot of times we just don't go out there and get approved because we think it's tedious process or it's just very difficult, right? Just kind of like when I got in the industry of mortgages, I'm like, I'm kind of not the smartest person. I can do mortgages. It's all about math here. Like, what does it take? Do I need a freaking PhD for it? And then, right? Like, I just didn't know what I didn't know.
You're not giving yourself enough credit. Okay, just aside from the whole conversation we're having, you got to give yourself more credit than that. No,
but you see what I'm saying is just like for me, I thought it was difficult until I tried it, and then like, oh my God.
Well, so
that was the process.
There's a segue. I'm sorry, Brian. I didn't cut you off. There's a segue because you're saying that about your relation to joining the mortgage industry, and one of the points of the article is that having a working familiarity of crucial facts actually helps. So, in the same way, those people who are mortgage ready and renting, being aware of of the and having familiarity of the critical facts and crucial facts, knowing what it takes to buy, that might help you out as well. So well, same for me. same.
I think it's more of like a like a personal belief that they don't think that they can buy a house, but in reality, it's like they never really tried, or no one ever really told them what to base it off, or they don't have the right information to take a confident decision. And I think that's the biggest thing. But at the same time, how do you get them to want to entice them to want to learn about that process? Well, if you're seeing rents go up and you're okay with that, well then maybe that's a light bulb that said, hey, maybe I should look into my housing situation. If rent keeps going up, is my income going to keep going up? Like at what point do I say, hey, maybe I should look into buying a house, having something more stable? Because as you know, rent's just going to continue to go up, and when it does come down, it comes down for a little bit, only to go raise it right back up again. So I think it's more of like, hey, I can't, because either I think it's too hard, but they don't really take the time to actually just ask the right questions. Which I feel would be the first step that you could get started.
It's so true. I mean, a lot of times we think, okay, well, I'm renting, I'm very comfortable, and sometimes we do have those landlords that they just don't increase the rent on you.
Yeah.
I mean, you've been there for 5-10 years, and they're not really increasing anything. But then you have the other ones that do run their homes as a business, and they do have increase the 5 or 10%, whatever is legal in your area. I know that Biden's passing a new law with that, to have rent control.
Yeah.
Because these things are happening, right? And so when we're talking with our first-time home buyers, some of the questions were like, well, Brian, what makes you want to purchase a home? They're like, I'm tired of renting.
Yeah.
Right.
Oh, okay, so you're tired of renting. What is it that you're tired of? Well, my rent keeps going up. Yeah. And it's going up now another $300, so I feel like I might as well just own a home. Oh, okay, good. Yeah. That's a good reason, right?
Yeah.
Because here's one of the things, guys. When you buy a home, here's the difference. When you buy in a home, you're locking in yourself for a 30-year fix. That means your payment's not going to change for 30 years. Despite of inflation or anything, you're in a fix for 30 years. Unlike a rent, every year it could go up anywhere from 5 to 10%.
Yeah.
So, and the cool thing with mortgages, we already understand, yes, right now affordability is very difficult. But if you are able to afford and you could get in there with the years to come, and the rates go down, you can actually tell yourself, hey, I'm actually making a little more money because now I'm paying less, and I get to put that in my pocket.
Yeah, and I want to draw a connection to the previous article that we talked about today when it talked about homes that are $1 million and above, and those in the $250,000 range. Because I think there's a massive opportunity for people, for these 7.9 million people, some of which do not live in most of which don't live in California, that you actually might be able to get into a house, just mathematically speaking. So it becomes more mostly just a choice, not even whether you can or can't. It's just, do I want to or not want to? Yeah. So real quick, you guys are chatting, and I'm looking. Basically, there's a 2-to-1 ratio of these homes that are these buyers that are mortgage ready, compared to the seasonally annualized homes for sale. So in the previous article, they're like, it's 3.89 million homes seasonally adjusted. Well, there's 7.9 million families that are mortgage ready, which is a 2-to-1 ratio.
2-to-1.
Now, we were talking about demand and that keeping up prices and all that, but this is where I think there's maybe a pocket of opportunity for people across the country, where if you are in an area and your rent is $1,500 a month, $1,800 a month, and there's a house down the street for $200,000 or $250,000, you should honestly seriously start thinking about whether or not that's a place you should be buying or not. Because even if you are an SFR and you're renting it for $1,800, your mortgage might be the equivalent in that space. So this isn't me selling you into being a homeowner. I'm saying, look, all I'm saying is, I'm not saying come sign the dotted line. I'm saying take a minute and ask the question. You might be in a really good situation.
Exactly. That's great advice.
Yeah.
Very, very true.
2 things here that they want everyone who is income mortgage ready to do. Number 1 would be checking your credit, which we, of course, were behind. And I think there's the myth that, like, checking your credit is going to harm your credit. Listen, the amount that your credit gets checked is the smallest weight of factors that weigh into your score. So just so you know, we covered this on the previous show, 65% of your credit score is generated by your credit history and your current balance relative to your limit.
Yeah.
Those 2 things together are 65% of your score.
Yeah.
Getting your credit checked is the smallest part of what makes your score. So getting your credit checked and then understanding debt to income ratio.
Yeah, a lot of people are just so fearful, like, it's a hard pull. I had a client, as a matter of fact, today say like, I'm concerned you're going to pull my credit. It's a hard pull. And I go, yes, it's not going to be impactful like that. If your credit's excellent, it shouldn't have an impact unless, have you been applying for other credit cards or have you been applying for car loans? No. Okay, then there's nothing to worry about.
Yeah, and in most cases, a pull can be 5 points or 7 points at that. But you make one late credit card payment, that's 100.
Oh, yeah.
Like, and your credit card minimum could be $40.
Exactly.
So you could mess up on a $40 minimum payment and lose 100 points like that versus, a hard pull, I might be 3 points scared of it. It's not even.
Especially coming, closer to ending a lease, and that's what this article talks about. Like, you're coming closer to ending a lease, and I'm talking about 4 or 5 months. It's good to be out there and start preparing.
Yeah.
Prepare yourself already on some of the things. And when you go to apply for a home mortgage and they pull the credit, they can actually see a simulator there to help you increase those scores if needed. If nothing's needed, you got excellent credit scores, well, perfect.
This is the advantage of doing the rapid rescore, which you talked about last week. If you needed to, you can simulate and look at what are opportunities for you to get from, let's say, 679 to above 680, or from 720 to 740 or something like that. So, honestly, take this advice and run to the bank. Take it to the bank. No, but seriously, do that. You can get your credit checked because it is part of your debt to income ratio, which is the other part of this, which is based on your credit. There are factors of whether your score or your interest rate is going to be higher or lower based on your credit worthiness, and your interest rate being higher or lower changes your debt to income ratio, which then determines how much you can afford to borrow from the bank.
That's right. I mean, we got to remember, lending is all about risk factors, right, Brian? And so one of the things we help our clients understand is like the article states here, understanding the status of your credit and your debt to income ratio is a good place to start. I agree 100%. There's no harm in checking your credit, right? I mean, the article states it here because it's 100% true.
Yeah.
For me, it's just I like to go by the Nike slogan, right?
Just do it.
That's it. Just get it done.
I was hoping that's the one you were referring to.
Right. That's what I was referring to.
Can we talk about debt to income ratio a little bit? Because I know you guys both have that conversation a lot. Brian, I know I overhear you next to me. We're talking about debt to income ratio. Over here, you're talking about debt to ratio. I see you got a couple notes there.
No, it's too expensive. You can't.
What were you going to
Mira.
Wow.
Mira nomás.
What was it you looked like you were going to make a point about this part of the article.
So it said right here that, you should go based off the 2836 rule, which, I mean, unless you're banking in a lot of money, that you could go off of that. And I just broke it down, a little simple math. In California, the average salary is around $84,000, which breaks down to easily $7,000 a month, and 28% of that is only $1,969. So you tell me where in California you're able to,
wait,
utilize
what? Do your math again.
So
what'd you say the income was a month?
84,000.
Yeah, divided by 12.
Divided by 12 comes out to 7,000.
7,000, right?
So I use 7,000 times 28%.
1960.
That's what
That's
I got.
it.
Got it.
Yeah.
So that's what this is referring to, which is
exactly.
It's not the norm.
Thank you for the math check.
Yeah, no. I thought I saw 1,060. I was like, that can't be right.
No, 19
I'm sorry.
change.
I didn't hear you say it right. So sorry.
There's no way we're going to find rental on that.
But either way, I know you checked it because it looked a little low.
Wait a minute. Hold on a second.
But my point is that, it's really difficult to go based off these examples when, in reality, that's not what's happening out there.
Yeah.
Then they can follow it up and say, well, on average, it's actually going to be around 50 to 55, 45. That's a little bit more of, realistically what your debt to income ratio is actually, used when lenders are looking to approve you. So I think for me, the most important thing here is understanding that they go based off your minimal payments. So if you believe hey, I pay a lot in debts, or I'm just holding a lot of debt, they're not going to approve me, calculate your minimum payments and then divide that by your income. And that's going to let you know your true debt to income ratio that the lenders look at. And that's exactly how they'll calculate it.
Yeah.
There's something else too I want to make sure I bring up. When it comes to debt to income ratio specifically, is it's different based on the type of loan you're looking for. VA is a little bit different than FHA than conventional, right or wrong?
Correct.
Right. They're generally in the same ballpark.
So if we go with conventional go all the way up to 50%, 49.99, okay?
Yeah.
Front end and back end. What that means is their current mortgage payment, no more than 49.99% of your income goes towards that, right? Yeah. The back end ratio, or your total housing ratio, no more than 49.99 of your income can go towards that, and that's including your credit card debt, your, that
taxes,
stuff.
Insurance, all that stuff. Yeah.
Well, no.
You mean including personal payments?
Personal tax, correct. Your car payments and all that stuff.
Yeah.
Please know, cell phone bills and all that stuff don't count. It's stuff that's just right on your credit.
On the credit report.
With FHA, it's 46.99 front end. Back end could go all the way to 55, 56.
Right. Depending on your credit compensating factors.
Exactly. And you have to have good credit. I mean, there's certain things. VA, we've seen it as high as 78.
Yes.
79. Yeah. Back end.
And that's because they use a different formula.
Yeah.
Front end, I've seen, I think the highest, I'm going to probably exaggerating here maybe a little bit, but I've seen it to 57, 58%.
Yeah, high 50s.
Yeah,
for sure.
And you got to have excellent credit. You have to have
minimal debts.
Money
in the bank.
Yes.
Yeah, money in the bank,
and obviously good job working history. You don't want to have any gaps. Like
Exactly.
you literally just want to tee everything off, because then the bank will look at it like, okay, based on everything that we see, even after your mortgage payments, even after you make every payment, you still have X amount left over to be able to pay. I wish they would be able to do that for any other, type of loan, but unfortunately, you can't go higher than your debt to income ratios on other loans, even if you have the compensating factors.
Yeah.
I only bring it up because I didn't want the conversation to get like locked in and cornered onto like, oh, this is just a hard and fast rule. It is the best rule when it comes to like how to maybe prepare or figure out without talking to someone like us, knowing where am I financially with my income compared to what I can afford every month. But when it comes to VA versus conventional FHA, they have different ratio thresholds. Number one. Number two, VA specifically uses a whole different formula for calculating the net residual monthly income. So after like all that stuff. So there's that part. The other thing too is remember that if you are paying child support and alimony, those are going to count. Student loan payments that are on your credit report, all that stuff. So if you
if they're deferred, we have to.
If they're deferred, if you've co-signed for somebody else, like all that stuff's going to come to play. Yeah, so we're having that kind of this like nice little conversation about debt to income ratio, just about your credit. Yeah. But if you co-sign for people, child support and alimony,
that's on there.
That's all going to be in there. Did I forget something else, guys? Or those are the ones.
No, but one of the things I did want to say is that speaking with a mortgage professional can help you map it out, and I think it's very important that you do connect with somebody you trust or somebody that you're able to ask those questions. I am very, very, very confident that everybody on social media follows a lender or a realtor that you can reach out to, ask these soft questions through a DM. Very, very easy to digest. You're not getting pushed into anything, but it's going to open up the door for you to start, oh, okay, I can do that, or based on my situation I can take that route. So I would say, even as dumb as you think the question is, shoot your DM, and you're going to find out that you're going to get the right answers. You're going to get pushed in a direction where it's going to bring you a lot more clarity, and it's going to give you more confidence if you want to pull the trigger or not.
Yeah. Hey, Brian, how funny was it when you saw that 28-36 rule? I mean, it's part of our test, right? Like, come on. What world are we in?
It's like twice.
I want to know what their income is. They probably have really high income.
Yeah. I'm like,
no, we're here right now.
Like, that's a very, very, very conservative debt to income ratio.
Yeah.
Relative to what the products are on the market that offer. So this segues us nicely into our next topic, guys. This is from CNN. We don't talk about CNN a lot here on this channel. But the worst may be over for home buyers. I don't know. Maybe not. I mean, it's a catchy headline. Caught my attention relative to what else we're talking about.
So, I think they're just like, here, stick that on the article. Let's see if.
So we got section 1. Is it a buyer's market? We got section 2. There are millions of people that are mortgage ready, and then section 3. The worst may be over for home buyers. I don't know. I mean, without going into the details, what do you guys think? Is the worst over?
Somewhere?
Is the worst over for home buyers? Yes or no?
No, I just think the worst isn't. I don't think the worst is over, right? I think it's like they're trying to make it see like I think like it would have been better said like there's light at the end of the tunnel.
Okay, that's great,
right? Because it's not, guys. It's like there's still a lot of market conditions that could still affect all of this. You know what's funny? I when I'm talking with our clients. And they're saying like, oh yeah, I already know that when the next president comes in, the new one, they're going to reduce the rate.
But they don't.
People, the president is not going to lower the interest rate. Okay,
that's not a foregone conclusion.
This is.
It is, Andy. It is.
Oh, but apparently, yeah. I stand corrected.
Depending who you ask,
right? Like it's just, it's just like okay.
I think for me, the way that I look at it, and I know I'm in agreement with you. I just feel that we took the elevator up and we're now taking it down. There's going to be the stairs that we take down, and it's going to take a substantial amount of time to get us down to where we need to be. Because if we take the elevator down, we're going to take it right back up. So it's really difficult for the rates to just tank. That's going to help affordability get better, but at the same time, doing that will just put us in a bigger hole, right? If not right back to where we're at.
If we reduce the rates too quick, then we're going to have deflation.
And it sucks because
that's not a good thing.
Us speaking that we thrive off of this, and this is what feeds our business. Yeah. We know that it's not healthy for the overall market to do it at a blink of an eye, because it's just going to cause more problems, and then we really don't know what would happen.
We're living in the middle of those wild swings. We're for the years that were plentiful a couple of years ago. We were living in the middle of the wild swing of rates going all the way back to 0 to 0.25% on that range for a while. We refinanced half the planet, and then they got ratcheted back up very quickly starting in March of 22, and now we find ourselves where we're talking about is the light at the end of the tunnel, and is the worst over for home buyers.
Interest rates are still higher than last year. They're still higher than last 6 months.
Yeah,
we're still not there.
Yeah, no.
But here's, I guess, the thing I still maybe am having a hard time digesting when we read some of these articles is they talk about like home price acceleration slowing, like it's a good thing, but the people that are chasing it are still just chasing it. So, a show or two ago, I was talking about how, if rates come down and people can save on their monthly payments relative to credit card rates and car rates and things like that, like that's fine. But if you're underwater $1,000 a month and now you're only underwater $750 a month, you're still underwater. It's just by a little bit less. And so when we read articles like this, I understand the kind of optimism and the hopium, but trying to sell the idea that home price appreciation is slowing is a nice way of painting that if you're chasing it, you might just have to be chasing it a little less. It's not running out ahead of you as fast.
Yeah.
Right.
But you're still chasing it.
Yeah. I like how the article, right? The worst may be over for home buyers. And then they put here in a recent report for real estate marketplace, Zillow found that nearly 1 in 4 home sellers offer price cuts in June. That's the highest level for that month since 2018.
Yep.
Come on. Is that why we're saying these are happening because people are putting their home prices too high right off the bat?
It might be true, but I think I'm just being critical of the article. I think they're cherry picking that one just a little bit.
Yeah.
But no, because I still see it like, one of my partners has a listing, right? And they went up for 1.8. Then the other house down the street, 1,000 square foot bigger, an extra room and an extra bathroom, went up for 2.1. But just because they're in the same street, both very nice houses, both very luxurious homes.
Yeah.
It must be.
The seller on the 1.8 is like, well, my house is 2.1 if that house is up for 2.1.
Correct.
And now his mentality is that I'm only going to accept offers that come up to that range. So we go back to that again, that it's a lot of sellers thinking that they could list at prices from years ago because that's the last time that they actually were, somewhat interested in the market. And now when they come into the market and the realtor or the person that's guiding that is telling them, hey, this is how it is, they're like, no, that's not how it is. And the realtor, of course, is not going to go against their client. So
their bread and butter.
Exactly. So we're starting to see that, okay, let's list it up for what you think it is, and let's see what the market says. And I think that's, exactly what needs to happen. You're going to put it up on the market, and that's where we start seeing price reduction. The market doesn't like it. They're going to tell you what the house is going to be sold for.
And some of that is actually either echoed or being led by some of what NAR is saying here. Their chief economist, Lawrence Yun, was quoted as saying, we're seeing a slow shift from a seller's market to a buyer's market. Now, that quote is kind of treading lightly because it's not like full-blown buyer's market, but he's also saying that there's a slow shift. So I think he's picked his words pretty carefully there. But it would indicate that there has been a shift towards, I'll say, neutralization in some areas where the rampant increase of price has stopped and it's like kind of leveled off. And then you see these months where there's some house price cuts, but these price cuts are not by 5% of the list price.
Yeah,
that's more of a massive haircut. We had a friend of ours who sold their house a couple weeks ago, and they did a price cut, but in terms of a credit. So by virtue of changing their net proceeds, the price was the same, which doesn't sound like a cut, but it was a cut to their proceeds.
Yeah.
So they had to do some roof repair. Okay, so on an $860,000 home, they did $5,000 of roof repair. That's not even 1% of the total value. So take that into mind when you read these kinds of things.
There's exactly,
nuance.
Andy. That's actually you're absolutely right. It's very true.
Nuance in those things. So look, it's great that home price appreciation is slowing. We still have an affordability issue. We're not out of that. I don't agree that the worst is over for home buyers. Not that there's more pain to come. That's like super punishing, but it's just not become easier on the general spending every month either.
Yeah.
Absolutely, 100%. Affordability still at its worst ever.
Yep.
Right? And so we just got to wait till things come down. Interest rates start coming down. I think we'll start seeing, with more inventory, we'll start seeing a little more, activity, et cetera.
All right. Agree with you. I want to make sure we make a pit stop at this last item, and we can kind of blitz through this, guys. It's not because I'm trying to rush to the end of the show, but we've talked about HELOCs a lot. We've talked about scenarios for HELOCs. I picked this one from Bankrate.com because they've actually been doing a really good job recently of kind of hitting the nail on the head when it comes to, hey, this is market relevant right now. And they made this really cool article. Click in the description box below where the link to the article is, and it has the top 10 ways to get the best HELOC rate. So let's just rip through these guys if that's okay, because
please.
we've kind of talked about all these things at the 30,000 foot level, and then we've also talked at the granular level where if you need help or you need to run a scenario past somebody and see if a HELOC is going to work for you, that's what we're here for. So can we just like rattle off some of these?
Perfect.
Right,
I mean, one of the things that I do want to clarify with people, because I've been getting, even though we've been providing this information to our clients, etc., they still ask, what's the difference between that HELOC and a HELOAN, right?
Oh, it's good. Yeah.
So one of the things we understand, a HELOC is a home equity line of credit. It works like a line of credit for like a credit card, right? You get approved for say 100,000. You're able to utilize that almost like a credit card. If you could only use 5,000, 1,000 here, 10 there, and there's no restrictions on what you can use it, right? Whereas a HELOAN, if you get approved for a HELOAN for 100,000, they're going to give you the money up front. It's a lump sum. It's a payment. It's fixed. That's it. With the HELOC, it's going to be an adjustable rate mortgage. But now that we're getting the information that rates may be going down, it may be a good time to say, hey, I'll go for a HELOC, right? Because your payment is going to be based on your usage of that credit line. Versus a HELOAN, you're making payments on the full amount day one.
Yeah.
You know?
Yeah.
So that's kind of like the difference, to put it in a nutshell.
Good clarification. Yeah. That's good to know, because they can be confusing because the acronyms sound very similar. So
very.
So really quick, top 10 tips. First one, maintain good credit. Hey, check. Covered good credit on the
Here
show.
we go again.
If you don't know about your credit, you can get a credit check. Have enough equity. Once again, maybe you just got to talk to someone who's in your market, who is a realtor or loan officer who can help you give a real quick check of that. Consider different types of lenders. This can be, I can get behind this if, in fact, your local credit union is going to do better than, the big bank, if you will, the corporate banks, the big name
credit
banks.
Credit unions are probably very good, a good pit stop to go in there and check.
Yeah. Understanding introductory rates. This one, I want to make sure we kind of, I'll say, forewarn people, like introductory rates do have an expiration. It could be a couple of months, it could be a year, or maybe sometimes 2 years, but it just really depends on the terms and conditions of the loan. Look for rate caps, meaning the peak at which the HELOC could go up in a changing environment rate-wise.
Because it can change on an annual.
Yep.
Yeah, there's a term for that. There's a time term duration for that change, and there can be caps on that.
That's on a HELOC?
On a HELOC, yes, not on a HELOAN, on the HELOC. And then factor in fees. So there are fees to closing any sort of lending transaction, so leave some space and some margin for that in your either personal budget to pay the costs or to wrap into the
usually it's an appraisal
loan,
and a minimal fee.
Yeah.
They're very minimal. I want to say it's under $1,000.
Yeah. Watch out for balloon payments. That could be a feature in, not to say less of what we see, but it's still something that is in the market to be aware of. Did you have a comment on that?
Yeah,
balloon?
Balloon, a lot of times we don't understand. We think it's just a red balloon, right? So no, a balloon payment usually it's going to be like anywhere from 5 years, 10, 15 years. The norm, I think, on HELOANs, HELOCs, they're like 15 years. What that means is you got 15 years to pay the full balance.
It's a lump sum.
Because with HELOCs, you pay interest only.
Right.
Unless you add more to it, you can pay it off. HELOANs, you're going to pay that puppy off.
Yeah, and there's a date on the calendar in the future that's got a red circle around it where that whole payment is due. So that's the balloon payment.
That's the red balloon.
It could be at 5. I was trying to weave in the red part.
Yeah,
that's part of like the 5 year, 10 year, 15 year. Yeah. So beware of that. You could choose shorter draw and repayment periods, this is more of a suggestion, I think, in the article.
Yeah.
Look for fixed rate options. That is possibly good for you if, in fact, the fixed rate is better off for you during the time that you need it versus the interest only.
Exactly.
So there's that kind of tactical part. Strategize around that.
Strategize and the loan officer or the person assisting you, hopefully they understand the market and they have all this data that can indicate, hey, rates are going down, so why lock myself in at a 13% when I can get a 13%, I know that next year my rate's going to go down to a 10% or 9%.
Right?
Yeah.
So. And then the last thing they mentioned here is take advantage of discounts. And it's kind of a two-parter for me. Discounts are not always available. Sometimes they are. And that is the next point is that, remember, banks and lenders are in the business of lending money to make money in return. So they want to lend money out. So if you are in a position where you need a HELOC or a HELOAN and they have the money and they're offering a discount, that should be like a identifier to you that they're looking to lend that money out. And sometimes you can get a deal.
Yeah, Will's got your money, and so does Brian.
Take my money. And one of the things I just wanted to, drive home on this point was that if your credit card has been carrying the weight a little bit more these last couple of months, do not wait until it's maxed out. Do not wait until you have no more options. Start having these conversations now, because like they said in the beginning, the biggest thing they check for is your credit, your debts. And if you're maxed out and your credit is low, you're going to have a low chance of getting your HELOC approved. So make sure you're being proactive. Hey, I need to have this conversation. What's it going to look like? Future pays. The winter's coming. A lot of more spending gets done in the winter with holidays coming, people traveling. So just take this time. The end of the summer's coming up to really just game plan for the winter, because, rates are coming down. So that might be a good opportunity for you to snag a HELOC and, cover yourself with a, winter blanket.
Yeah. Yep. It's all about the 3 PPs, right, Andy?
Yes. Prepare. Well, I say prepare. But
Prepare,
predict,
plan,
and plan, predict. We have more P's than
persevere.
Persevere.
But no, that's very true. That's awesome advice, Brian.
Thanks.
So you were talking about the credit card rate. Now I wanted to just throw out, I think it's 21% is the average right now. I know some are as high as 29.9 or whatever. But the point being that to dovetail on that a little bit, just to close my final thought here, is they're in the teens, even in the mid-teens, is better than the 20s. That can make your life a whole heck of a lot better by relieving some of that stress and taking the better offer, and especially if there's a discount. Give it a second look. Give it a second look.
I'm going to tell you guys that what Brian just said, you hit the nail right on the head. I ran credit, and I'm like, how did their scores? Because when I first got them in their home, they had excellent credit. Mm-hmm. And then when I run their credit, I'm like, why did it go down to a 608?
Yeah. Mm-hmm. Yeah.
What happened? And it's they have late payment. So I'm looking for late payment. They had none. Their credit utilization was so high that remember, credit utilization impacts it by 30%.
Yeah. That's 30% of your score.
Right?
Mm-hmm.
And so man, they got nailed. So I asked him, the cool thing is we run these simulators, so I had him pay $1,400 and change, so he could go above a 640. Yeah. That way I could put him in a better position.
And to follow up on that, one of my clients was looking at a HELOC initially, but then after we ran the credit, did the numbers of what it was looking like for a HELOC, their credit was low, that it was going to spike up the payment higher, so they had to look into doing a cash out refinance. And that was another option. If your credit is a little bit shot, looking into a cash out refinance through FHA or VA if you're a VA client will be a lot more accessible and help you have let you have a little bit more debt, let you carry a little bit more of a less credit score. But at the same time, that shouldn't be an excuse for you to say, hey, I could just go to that route. Because then you do have to refinance your whole property. But, that's another story.
Can I hit you guys with some quick lookups?
Yeah.
Just real quick. So I just looked up average credit card rate right now. Forbes is reporting 27.62.
What?
Lending Tree, 24.84. NerdWallet, 27.7, and Investopedia 24.72 as
crazy.
Median and or average. So I typed in average. Some of these said median, some of them said average. But
still,
Andy, and if you're making the minimum payments on that, it's going to take you 13 to 15 years to pay that off.
Yeah, at least. Just. God, yes.
I'll let you borrow $100 if you're going to pay me $27.
If you own a home, if you own a home,
that's so true.
If you own a home that has equity and you unfortunately have had some behavior that has led to high credit card balance at really high rates, please make a comment.
Yeah.
Let us help you.
Yeah.
Let someone else locally help you to get out of that.
Or if you've
drowning
been through this situation and you got the HELOC, please let us know how your experience was, or if you did the cash out refi.
All right, let's do this.
Best part of the show, Memo. What do you got?
I'm glad that renters, are more home ready, that they're looking at that. And I'm glad for that. I don't want to see us be a renter's nation. I want to see an owner's nation. It's a proven fact that if you own a home and you retire, you're going to be better off.
Yep.
So why don't we put our people in homes so they can be better off?
Yeah.
So I like that.
Great. Brian.
I'm gonna go with the worst, maybe over for home buyers. The positive attitude is refreshing, but I don't know how much I trust CNN. So I just thought that was cool that they let's see if this.
You like the 28 over 38 bet to income
I think it was not to plant that there, but
It was a 28 to 38 ratio that he liked.
It might be because I'm an old man too, but I'm with you today. The amount of people that are mortgage ready, I was actually really surprised by that. The 7.9 million people, it's a huge number. Even if it was half at 4 million, I'm super impressed with that. I really hope that people take the advice from section 2 of the show today, that if you are still watching this far through and you skip past that, go back to section 2, watch that about how many of you might be mortgage ready, especially in areas where the home prices are in that $250,000 zone, even 300,000 zone. The rent prices are probably keeping up with what that mortgage payment is. Get yourself a house if you can.
That's right. Do it.
Yeah.
Nike, right?
Yeah, just do it. Yeah. Thank you guys for a great show. Thank you all for watching. Remember to subscribe to the channel, like this video, share it with someone who can benefit from the knowledge we're sharing here. And if you need help, reach out to one of the guys. We'd love to help you win in mortgage and real estate. Any final thoughts before we sign off?
Yeah, that's what we're here for, right? Just ask away. Who cares? There's never such thing as a dumb question.
Nope, not at all.
You know, it's only dumb if you don't ask it. So just ask it, DM us, do whatever you need to do.
Even if the answer is we don't know, we'll find out.
Oh, we'll figure it out. Oh, yeah. We
I
have
don't
a lot
know.
of
I'll find
resources.
out.
That's a great question.
One thing I've been learning how to do is utilize my resources.
Yes.
Something I never did because I thought it was an inconvenience to people. You know what? They offer it, so ask away. Go use it.
Yeah.
Definitely.
All right. Well, thank you guys for another great show. Thank you all for watching, and we'll see you again next week.
Bye, guys.
See ya.